Hey guys, it's Justin here from Better Wealth, and today I'm going to dive into all things interest and borrowing against the cash value. And I'll say, really answer the question that we get often is, why would I want to borrow against my money? Why would I not want to just use cash instead? Other question, am I really paying the interest back to myself? And then if all of that is good, when would I even want to borrow against my policy? So all of these questions tied into one and really looking at the advantage of why you would want to borrow against your policy versus using cash. So going to dive into that. And to start, I think it's going to be helpful to look at common ways that people currently use their money versus what we can do with something like the AND asset, high cash value life insurance, and really utilizing the concept of leverage so that our money can continue to grow uninterrupted. All right, so first we're going to look at the person, call this person the debtor. So the person that starts off here in this flat line, borrows money, and then pays it back with interest over time. So you can see here in this graph, if this line right here going across is zero, we borrow, so we are in the negative, then we slowly work our way back up, we get back there, and then we drop back down to zero. I'll say this is where most people today are at. See, this person just continues to borrow there over time. And we can see here, I've just used a $100,000 loan. So taking a $100,000 loan amortized over 10 years at a 5% interest rate. And you end up paying about $27,000 in interest over that time. So paying back monthly a little over $1,000 per month there. And you see your net value. So as soon as we borrow, now we owe all that's left in that first year, we pay that back. And I'll say this is where most people are at. It's somewhere where, yes, you get it back up and you work your way back, but you end up back at zero there. That's where most people are. And the next place that we'll look at is the saver. So in this case, this person, again, we start at zero here. So if this bottom line is zero, this person doesn't borrow, so they never go into the negative, which is a good thing. So savers definitely not bad. They build up their savings till they get to the point that they want. And then after that, they drop back down to zero. So they save it up. And then once they spend that money is now gone from their ecosystem, gone to pay for whatever it is that they were looking for. So in this case, starting off with $100,000, say they had that $100,000, that $100,000 leaves, and now they have to build back that value up there. So this person doesn't pay any interest, but what happens is they lose out on the interest or the opportunity cost, because once that money is gone, now it's gone forever. It's not going to be working for them anymore. It's not going to be growing, and they have to go out and earn more of that and continue to save up there. Saver definitely in most cases better than the debtor because we're not paying that extra interest on top of it. So we will end up with a higher value and it can be better there. But this is where the next amount of people are at. So most people, at least in America today, would be the debtors, continuing borrowing, going into debt, working their way back up to zero. And then other people are the savers. And here actually used a 2.3% interest there that is going to grow in a high yield savings. And that's just the average that I pulled was actually 2% over the last 10 years. So I bumped that up a little bit and using that. So we are actually getting some growth, but it is very minimal. And as soon as we pull out any dollars from that, that growth is gone from our environment there. Then next is we're going to look at the person who uses leverage. So this person uses leverage to get more value and more efficiency out of what they're doing. So the biggest thing here is that we're going to have uninterrupted compounding. It's going to continue to grow for the rest of your life. And we'll touch on why we like specifically designed high cash value life insurance policies for that. But in any case, this is just looking at not pulling numbers from a life insurance policy, just using the 4% growth here, or actually 4.25% growth here, use the number that would be similar to the growth in a life insurance policy, as you see 4 to 5, sometimes 5% over the life of that policy there. and same $100,000 coming out. And we actually pay a little bit less in interest here because we're paying that back over time. Our balance is going down. And so we're able to save ourselves a little bit there. So already from that aspect, we can look at, borrowing against that policy may be better because we can pay that back a little bit quicker, even though paying the same amount each year or each month there. But the real advantage comes here is we see now we're not staying at zero. Once we put money into the life insurance policy, it's going to be guaranteed to continue to grow. Just going to be a matter of how fast is that actually going to happen. So we can see here we go up, we borrow against the policy, that drops. We now have a cost of capital. So we do have to pay a cost of capital for that. And then we pay that back just the same as we would a normal loan. You pay it back over time. And now you look and our net value is actually going to be higher than it was when we had just started. So we didn't here work our way back to zero. We worked our way back up and we are now ahead and have that filled up. We have more cash value available. Now we can borrow against that again and continue to do the same things, and it continues to compound and grow for, again, the rest of your life once it's in that system there. So I say here it's very similar to if we just look at the concept of leverage. Very well-known example is that Elon Musk, when he bought Twitter, he borrowed against his Tesla shares and was able to do that. And many of the people were saying, oh, wow, that's crazy. I didn't know that you could do that. Some people were saying that's unfair. That's how the wealthy stay wealthy. They shouldn't be able to do that. But it was all over the place whenever he did that. And this is the same concept. We're just using leverage so that we don't have to interrupt the compounding of our assets. In his case, the stocks. In this case, the use of life insurance and that cash value there. And I'll say the reason we like to talk about life insurance and like that aspect of it is because, one, it's guaranteed to go up, just a matter of really how fast it's going to grow. There is no volatility. We're not going to have to worry about it coming down, and we know what we have in that case. So, but really, this is just looking at the concept of leverage there.
Hey guys, I just wanted to interrupt real quick. If you're watching this and have an index universal life policy, a whole life policy, have any type of insurance policy in general, and you're like, I want to know if I'm on the right track. I want to know if this is set up properly. We at Better Wealth want to help you. We want to give you a free policy analysis and show you, are you on the right track? Is there some things that you potentially could be doing better? And so we have a link down below that you will have access to. We would encourage you, if you have a policy and you want to see if you're on the right track, check that out. And if you're someone that's watching this and you're like, I want to talk to someone maybe setting up a policy for myself, or I have questions, we would love to serve you. You can also see a link to have a call with someone on our team. Back to the episode.
So now you say, all right, I understand how that works. I understand you can borrow against it. I see some of the advantages of that. But now my question is, well, when should I borrow against my life insurance policy? So if that's the case, I know I can borrow against it. It's going to continue to grow. When should I actually borrow against the policy? Well, that's a great question. And I know there's tons of videos out there showing, hey, you can use it for this, you can use it for this. Some people say you should use it for everything, finance everything in your life through your insurance policy. And so if we just look at this graph here, take a look here and see if we never borrowed against the policy, you see here as it goes up, we're going to end up at the same value. So some people, I've seen videos where, hey, you buy a car and that's how you're going to be rich. You just buy stuff through the policy. And we started off here. By the time you pay the car back, you have more money available to you, which is true. You do have more money available to you. However, even if you didn't borrow against that asset and use it for a car, you would still be at the same place. There, you just had to pay a little bit cost of capital. You still had to pay that interest there. So you would have ended up in the same place whether or not you did that. Now, we can look up here. We just said we saved some interest. So would that perhaps be a more efficient way to do some things? Yes, especially if you're looking at 10% interest rate on some debt, 20% interest rate on some debt. You can utilize it to maximize the efficiency of those debts. And then as you pay them back, now you've refilled the bucket and can go out and then do something else, pay off more debt if you want. So I'm not saying it is a bad thing and you should never use it for it, but just want to clear up the misconception that get a life insurance policy, borrow against it, and you will end up wealthy. You get a life insurance policy, it will continue to grow, but it's going to continue to grow whether you actually use it, borrow against it, or not. That is what it is designed to do. So that answers the other question of, am I paying that interest back to myself or am I not? And the answer is no, you are not paying interest back to yourself. So we see here, we did end up paying a cost of capital, and you hear that mentioned a lot. You do pay interest back to the insurance company. Now, like we said, we can make it more efficient if we are using the insurance company's money, but there is still a cost there. It's not you earn all that interest every time that you pay it back. There is cost to being able to do that. Now, I know the argument too that some people say will be that, yes, you're paying it back to the insurance company, but they're making more money. Now you're earning a dividend, which is true. So maybe net those costs aren't as great as what the actual interest rate you're paying is. However, I just want to make it clear that a misconception that you do not pay interest back to yourself, but that can still be a good thing here. Now we say, all right, so I can use it for debt. Sometimes it can be more efficient, but what's perhaps the best use case of a policy? And that's where we here at Better Wealth like to look at it as an opportunity fund. You could use it to pay off debt, but what if an opportunity comes while you're here at the bottom paying back that debt, and now you need to do something else? So now we see you can use it to pay off some debt. In some instances, it's going to be better, but you're not paying interest back to yourself, and there is still that cost of capital. So really only going to be advantageous in certain situations. And so you say, well, I hear about the wealthy using this, and I want to be able to use my money in multiple places and become wealthy like they do. So similar to what we talked about earlier with Elon Musk, he borrowed against his assets to buy a business, an income producing opportunity. And that's where you can really start to gain on a policy there. So you would pay into a policy, it's growing for the rest of your life. You borrow against it for an income producing activity. Say you're paying 5% interest, you borrow against it and you can earn 6%. Well, you made a little bit of a spread there. Say you can earn 10%. Well, now your cost of capital there was 5%. You earned 10%. So you earned a 5% gain there. But in actuality, you already had that money in there. It was going to grow whether you utilized it or not. So that 5% you paid to be able to borrow against it, you earned 10%. So you really earned a 100% rate of return there. And that is where you really start to see the gains, because now you're earning and you're making more income there, and therefore paying back that policy loan quicker. And now you have a new bucket. You can continue to borrow against it and go out and build wealth in that way. So that's what the banks do. They get your money. They pay you 1%, 2%. They're lending it out at 8%. They're not just making a 6% spread on that. Their cost of paying for that money and utilizing that money was 2%. And then that's how you can calculate the return on that. Now, lots of different things we can look at. Some people I know say, I don't have opportunities. I don't want to invest. I'm going to use it to pay off the debt. In that case, if you don't have the opportunities, you can use it to pay off the debt, and it can work for anything there. It can work for whatever it is that you want to use it for. We just like to look at the, I'll say, best use case of it and really clear up some misconceptions out there that just because you put money in there, borrow against it, now you're becoming wealthy, or that you're paying interest back to yourself. So hopefully that cleared up a few misconceptions there, but wanted to keep it simple with this graph here, show a graph of how it can work there. And then wouldn't be the and asset channel if we didn't look at an actual policy here today. And so going to look here at a policy, and in this case, somebody who did a $100,000 front load and paid about $25,000 every year and then dropped off and funded minimally after that. So in this case, you see right here, I do have a loan coming out of the policy. So not going to dive too much into this, but if we come over here and look at our net cash value here, so that's going to be the biggest thing. Our net cash value, year one, put in $120,000, get a little over 90% liquidity. So we have 111. We borrow against that, start paying it back this next year here. And our net cash value goes down, but it's filling up as we are paying it back, so that by the time we get to year 10, we still have nearly $400,000 of cash value there that has grown. Our cost that we have paid back is not going to be that much. The growth is outpacing what we have done there. And so that's where really you see that it's a matter of refilling up that as you go. And especially if you're doing this for something where you are earning an income, making more money from that, and then therefore we have more money that's paying back quicker. And you can see how it can really start to compound in multiple ways. And I know as you put money here and have that opportunity fund, a lot of times those opportunities you'll find those because, hey, we built up $500,000 of cash value. Now we are looking for opportunities, looking for ways to utilize that money there. So hope that was helpful for you today. If you have questions about any of this, feel free to reach out to anyone on our team. We can look at your specific situation, talk about what you're doing, what might make the most sense for you, and really dive into the details there with you. So hope that answers all the questions. Main thing, wanted to clear up any misconceptions about when should I borrow against my policy? How does this work there? So have a great day. I'll reach out sometime soon.